Hello and welcome. For China Solved, I'm Andrew Hubert, and this is a special edition of the China Negotiator. Today is Sunday, May 12th, 2019. U.S.-China trade war. Hope for the best, plan for the worst. The takeaway for today's talk. A trade war is upon us. So this is a time for hard-headed analysis and not hot-headed nonsense. And that includes not believing hot-headed nonsense. And for those of you going through your first trade war, you've got to take a step back and make sure that you are believing things that you should believe. We know far less about this situation than we need to. We know far less than we have in the past about similar type negotiations. And I've noticed that we are taking for granted third-hand commentary and third-hand reports about what's happening in the negotiation. The safest option is to hope for the best, and that usually means building cordial relationships with Chinese counterparties, but planning for the worst. And that means reviewing your BATNA and your Plan B options and making sure that they are not China zone based. Today's talk, what we know, what we don't know, and your next move. Let's take a look. What we know. Tariffs are going up on $200 billion worth of Chinese-made goods from 15% to 25%. The paperwork has been signed, and now it's just a matter of implementing. And there's also a possibility that the tariff could rise to 25% on all $325 billion worth of trade from China to the United States. And that's about it. That's really all we actually know. What we don't know the text of the recent negotiation. So without that, it's very, very hard to figure out what's going to happen next. And you'll notice that the principles of the negotiation are the ones not talking about it. So we really don't know what's been on the table so far. We don't know when or how this is going to end. There are two particular fallacies I want to highlight now. Fallacy number one is the obnoxiously optimistic, oh, don't worry, it'll be over soon. We have said that before. We said that in North Korea. We said that with the deals that replaced NAFTA. We said that about healthcare. We've said that about a number of things that just didn't end soon that are still kind of left hanging. And that seems to be a model for this set of decision makers. Other fallacy is that this is going to be the end of the world. I'm not saying that's wrong. I'm just saying you're going to need some backup there. So if you're looking for the end of the U.S., watch the stock market. Any big moves this coming week, starting on the 13th, could indicate trouble ahead for the U.S. And some people are saying that it's going to be the end of China. I would watch the renminbi rate. As the exchange rate reaches 7 renminbi to the dollar, I'd say it's time to be concerned. And what about your next move? Well, it's time to make sure you are operating off a good BATNA analysis. BATNA, of course, means best alternative to no agreement. And another way to look at it is your bottom line or your Plan B. What is your Plan B? It's time for you to check that because when you were originally making your China plans, your Plan B might have been to go across the street to another China producer. And that's simply not going to work now. And you need to find out if going across the street more figuratively and going to some place like Hong Kong or Vietnam is going to work, because it may not. The next 25% should be a deal killer for most of you. I don't care who's eating the 25%. If it's the Chinese producer, if it's you taking it out of your own profit, or if you're passing it on to the consumer. If you are buying manufactured goods from China, 25% should probably kill the profitability of your deal. And if not, you've got to have some big conversations with someone either on the China side or in your own accounting department. But if this doesn't kill the deal you've got in China, it should at least transform it in some way that's going to require thinking and planning on your part. And finally, figure out how to play the disengagement. U.S. and China, the economies are disengaging one way or another. It's going to take the form of a battle for alliances. And that's the next phase of the trade war, in my opinion. So if you're European, what's your role as a U.S. ally going forward? How is that working out? and what do you think is likely to happen, and how are you going to make that work for your competitive advantage? If you're in Southeast Asia, you're the belle of the ball. Everyone wants you now. China is really interested, and the West is starting to show new appreciation for your assets. However, the concern for Southeast Asia now, as always, is getting paid for the attention and the services provided to foreigners. U.S., what are you going to do? Are you going to transact elsewhere but build relationships here? That would have been a standard plan B during rough times in the past, but this could be long-lasting, and you may have to decide on both your allocation of resources and how to preserve and maintain your reputation at home. The final word. This is the time for hard analysis, not for taking sides. And you have to do a good check of where you're getting information. The knowns and the unknowns at this point both point to further conflict. The things we don't know are worrying, but the things we do know are not providing great comfort. So I would say as a long-term China watcher that we are probably approaching the low point in our relationship. And after crunching the numbers, you may be tempted to play the risk-averse option, which makes sense. Just be aware that does mean disengagement. So make sure your plan B includes a non-China and a non-China zone option. Thanks very much. I'll talk to you again soon.